Yet another fascinating week. Let's bring in Michelle Schneider. She's the Director of Research at Market Gauge. And boy, the jobs number coming out on Thursday. The market closed on Friday. So what will that mean for trading?
Well, every week has been an interesting week. I mean, that's been sort of the theme. This is the most interesting market I could ever remember in my lifetime in terms of equities. So, it's funny about the unemployment number. The initial unemployment shock that happened when COVID hit and the whole market went into a state of shock, I think was extremely more significant than what it is now. So right now, last month, there was that surprise improvement where it was only 13.3%. And the median forecast for this month now is going to be 12.4%, so even better. So in terms of what it means for trading is, first of all, it comes out at least before the trading day on Thursday, which also means that there will be some evening up ahead of a long weekend, as there always is. If there's a surprise to the number, either way up or way down, that will impact the market, but I don't think it's going to impact the market more than a temporary blip.
Good to know. What are you watching technically in this market?
Well, I have focused on two really big sectors right now that have to really hold up in order to keep the market from collapsing. One is the brick and mortar retail. That has been a laggard for years. And now, even when the S&P 500 and the IWM, the Russell 2000, collapsed last week under the 200-day moving average, the XRT, which is the ETF we like to use for brick and mortar retail, held up over the 200-day moving average. So that tells me there could be an interesting sea change in terms of the consumer sentiment, even though one would expect it to be dismal. People are actually out shopping. I know we did our part this weekend to help the U.S. economy. And then the other sector would be the financial sector, because there were two major rulings last week. One was relaxing the Volcker rule, which allows the big banks to make investments with money, which is something that hasn't been done since before 2010. And the other was that the Fed came out and said they wanted banks to lower their dividends and not do corporate buybacks. What's interesting about that is the Volcker rule is a more permanent change, whereas the corporate buybacks is good for the quarter. So we have to watch the banks and see if the banks can hold up here. If they can hold, and if XLF, which is my choice of ETFs to watch for the big banks, can get back over a key area or around 23, regardless of what's happening, the market could still continue to go up.
Well, on that note, have a wonderful 4th, Michelle.
Same to you guys. Thanks so much for having me.
For more Business First AM, check us out on social media. We're on Facebook, YouTube, and Twitter. And go to businessfirstam.com for where to see our show on TV.